Wednesday, halfway through the trading week. Welcome to Modern Investing Techniques, episode 15. I'm Patrick in Vancouver. Today is April 8th, 2026, midweek. Let's reassess this week's positions and look for fresh setups. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Iran's ceasefire triggers 15% oil plunge, unwinding the geopolitical premium and shifting capital across energy, currencies, and defensives. Markets opened with relief after the United States-Iran two-week ceasefire announcement. The S&P 500 sits at 6,617, up 0.1%. The NASDAQ Composite is at 22,018, also up 0.1%. And the TSX Composite sits at 33,238, up 0.2%. Oil prices tumbled below $100 with the biggest one-day drop in 6 years as the fear trade reversed. The Strait of Hormuz safe passage commitment removed a major supply risk premium. Central banks have moved into explicit wait-and-see mode on inflation and rate cuts now that the energy shock is diminishing. For Canadian investors, this means watching how the shift flows through the TSX energy sector. Many of you in your TFSA or RRSP accounts may want to scan for rotation out of pure oil plays into broader industrials and consumer names. While the broader market breathes easier, the real opportunity lies in systematically capturing the decay of that geopolitical fear premium, which brings us to today's strategy spotlight. This strategy involves systematically reducing exposure to assets that priced in elevated geopolitical fear once the catalyst dissipates. Then you reallocate to sectors that benefit from lower input costs and restored supply chain confidence. Today's Iran ceasefire and resulting 15% oil collapse perfectly illustrate the setup. The fear trade that had bid up certain defensives and oil service names is now unwinding in real time. Implementation is straightforward on platforms like Questrade or Interactive Brokers. Screen for names or exchange-traded funds that rose sharply on Middle East tension using 10-day price performance greater than 12% with elevated volume. Then exit or hedge once official de-escalation language appears. Simultaneously rotate into beneficiaries such as airlines, chemicals, and European luxury goods that gain from cheaper energy. Historical context shows this rotation works best in the first 5 to 10 trading days after a ceasefire or treaty. The 2015 Iran nuclear deal window delivered plus 9% average outperformance for energy cost-sensitive sectors versus the S&P 500 in the subsequent month. Of course, it carries the risk of renewed rhetoric reversing the move. Always size positions to 2 to 4% of portfolio equity. Use a 7% portfolio level stop on the rotation basket. The key discipline is acting on the policy signal rather than waiting for price confirmation, which often lags. If you run this in your TFSA, you can execute the entire basket in under 15 minutes on a single login. With macro volatility creating both opportunity and execution risk, let's look at a specific idea designed to take advantage of today's environment in our practice investment of the day. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Our practice investment of the day is a weekly hold on SWGAY, the Swatch Group American Depositary Receipt. The ticker represents the Swiss listing SIX:SWGN. Strategy here is an activist defense mean reversion play on shareholder vote clarity. Management publicly urged shareholders to reject the activist investors' board seat challenge. Such public rebukes have historically produced short-term relief rallies in family-controlled European luxury names as uncertainty is removed. On the technical side, the stock is trading just above its 50-day moving average on the daily chart. RSY 14 sits at 41, which is neutral and not overbought. Volume today is running 1.8 times the 20-day average on the news, confirming conviction. Nearest support lies at the 200-day moving average, approximately 12% below current levels. Suggested stop loss is 8% below entry with maximum acceptable simulated loss on this $1,000 position at $80. Target is plus 4% to plus 9% by Friday close as vote clarity reduces overhang. Confidence level is medium. Catalyst and volume confirmation are aligned, but offset by uncertainty around the final shareholder vote outcome and macro luxury demand. This trade demonstrates how to read corporate defense language as a positive catalyst rather than noise. It also shows how to use activist events as mean reversion setups instead of momentum chases. Listeners should learn to scan corporate filings and press releases the same morning they appear. Cross-reference with volume spikes and maintain strict position size and stop-loss rules. Those skills improve decision quality even when the weekly hold does not finish in profit. We will track this simulated position all week and evaluate it properly on Friday. Now let's review yesterday's trade. Our last weekly hold was TSLA, a contrarian fade of negative analyst sentiment following recent price weakness. We bet on an eventual relief-driven rebound. Entry was at $365.86 on Monday's open. Exit at $360.59 on Friday's close. Result was a loss of 1.44% or $14.40 on the $1,000 simulated position. Running total now sits at minus $44.91 across 4 trades. Win rate is 1 win out of 4 total trades for 25%. Current streak is 1 loss. The relief rebound we anticipated did not materialize within the weekly window. Negative analyst sentiment proved stickier than the technical oversold condition. We will tighten the catalyst filter to require an actual positive revision or insider buying alongside the sentiment extreme on future contrarian names. That is exactly how we turn losses into better process. Our simulated portfolio performance shows total trades at 4. Win rate remains 25% with 1 win, 2 losses, and 1 break even. Cumulative profit and loss is minus $44.91. Average return per trade is minus 1.12%. Best trade delivered plus 4.44%, while the worst was minus 7.49%. We are still in a 1-loss streak, but the AI analysis is learning from patterns like sticky sentiment and adjusting the filter rules accordingly. This remains a learning journey rather than a track record anyone should copy. Speaking of tools that help you act on these macro shifts, 2 stand out this week. First, Alibaba Cloud has released its Zhenwu Artificial Intelligence Data Center Monitoring Dashboard. Chinese retail and institutional investors can now access real-time utilization metrics from the new 10,000-chip artificial intelligence training cluster via the public Alibaba Cloud console. The dashboard shows GPU utilization, inference latency, and power consumption trends. That data has historically led Chinese tech earnings beats by 2 to 4 weeks. Canadian investors holding BABA or related names in an RRSP can set price alerts tied to utilization thresholds above 85%. The free tier is available while paid analytics start at approximately $49 per month. It gives retail investors the same early read on artificial intelligence capital expenditure momentum that institutions pay thousands for. Second, the Seeking Alpha Quant Rating plus News Flow Screener customization is worth exploring. You can replicate the newly highlighted Bain Capital Specialty Finance Deep Value profile by setting custom filters for business development company names, trading more than 20% below net asset value with dividend coverage greater than 1.3 times. Layer real-time news sentiment scoring to surface similar discounted yield vehicles the same day research drops. Free basic access is available, but the premium at $239 per year unlocks the full news flow overlay. This is ideal for TFSA income investors hunting discounted cash flow compounders. If today's geopolitical rotation strategy interests you, these tools help you screen for the exact setups in minutes. Now, for a few quick hits worth monitoring, Beyond Meat received a price target cut to $0.60 by TD Cowen amid ongoing plant-based demand weakness. The analyst downgrade reflects continued pressure in the category. Investors should tighten stops on BYND or use the name only in paired trades against traditional protein names. Watch for further multiple compression in the alternative food basket. Reckitt Benckiser shares rose 3.6% on Danone acquisition speculation. The rumor of a bid for the consumer health giant lifted the American Depositary Receipt ticker, RBGLY. Canadian investors in global staples exchange-traded funds may see indirect exposure rotate higher. Monitor for official confirmation because merger and acquisition premium events often provide 5 to 12% swings within 48 hours. Bank of America favors the Australian dollar-Japanese yen pair on lower oil prices and yen weakness outlook. The foreign exchange team highlights the pair as a beneficiary of the post-ceasefire oil drop and expected continued yen softness. Retail traders with Interactive Brokers or Questrade foreign exchange access can consider the pair with tight risk parameters. Canadian dollar investors should note that the Canadian dollar may also firm versus the yen in a lower energy cost environment. Finally, new Italian citizenship by descent rules reinforced by the Constitutional Court have tightened requirements effective since March 2025. This has derailed many Italian-Canadian return plans. For investors with cross-border estates, review your TFSA and RRSP beneficiary designations and consider accelerated gifting or trust structures before further European tax or citizenship changes ripple through. Now, here is something that most retail investors get wrong, and it cost me money before I figured it out. Imagine you placed a market order for 800 shares of an energy exchange traded fund at 9:35 this morning, right after the ceasefire announcement hit the wires. Your order filled at an average price 38 cents higher than the national best bid and offer quote you saw on your screen. Between your click and execution, high-frequency liquidity providers pulled quotes. The bid-ask spread widened from 4 cents to 27 cents. You paid an invisible 0.41% slippage on a $78,000 notional. That is order flow slippage in action during macro shocks like today's 15% oil move. Resting liquidity evaporates because market makers widen spreads to protect against adverse selection. On the TSX, many Canadian energy names routinely see spreads balloon from 8 basis points to 45 basis points in the first 30 minutes of such events. Professionals always check the depth of book, also known as Level 2 data, and the 20-day average daily volume before hitting market orders on days when the VIX or oil implied volatility is spiking. If depth within 10 cents of the mid is less than 25% of your intended size, switch to a limit order ladder or split the trade across 15 to 20 minutes. The biggest misconception is believing I got the price I saw on the chart. In reality, you got the price the market was willing to give you under stress. The one-sentence fix is on high-impact news days. Never use pure market orders in names whose 30-day average daily volume is below $40 million. Always layer limits or use volume-weighted average price algorithms instead. Before we wrap, briefly tease something to watch for tomorrow. We will look at how the CAD reacts if oil stays below $100 and what that means for your energy holdings in the TFSA. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. This podcast is for educational and entertainment purposes only. Nothing discussed constitutes financial advice, investment recommendations, or solicitations to buy or sell securities. The practice investment of the day uses simulated trades with no real money. It is a learning exercise to demonstrate analytical techniques. Past performance does not predict future results. Markets involve risk of loss. Always do your own research and consult a licensed financial advisor before making investment decisions. The host and NARA network have no fiduciary relationship with listeners. This podcast is curated by Patrick but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.